Good day to one and all. This is Dr. Sivaraman of iknowindices.com. If we are able to see the PowerPoint presentation, I'll be presenting now Asian session live market analysis of the 4 majors and 2 commodity pairs, and I'll also give the forecast based algorithm derived forecast, and for the week 12th to 16th November. And the webinar is presented on 12th November between 5 and 5:45 GMT. So the derived forecast is based on a sequential statistical analysis, and which is in a position to give the expected market moves on a daily basis and also for the week. So I am doing the update of the live market forecast on a daily basis in iknowindices.com/blog and also fxtrade.net. So there you will be able to see the daily expected market moves, and you can also use it as one of the input for your understanding of the market besides your own system of analysis. Now this derived forecast is for a pretty long period, so obviously we need to fine tune it on 30 minutes time frame on a daily basis or about 1 hour time frame. That is being done with the help of the market reading. So we note down the initial high and the low between 2:30 and 3:30 GMT in 4 majors and 2 commodity pairs and use them as the reference levels for the day, as the players also use them as a reference level and subsequently identify the type of moves they make, and also in what sequence they make the moves we identify, and try to understand what could be the next possible move. And for that, the most important thing is the session timings followed by that of the players, and that is in terms of GMT. So we use the live market code page. I'll give the link for the same in the chat window, and you'll be able to just click on it and get that live market code page opened, and there you come across the GMT time. It is 5:03 GMT now, and also we note down the bid and ask at the current level. So euro is trading around 1.272729, and this way you will be able to note down that, and also note down the initial high and the initial low around 3:30 GMT. And we participate in the market only when they breach the initial low or the high, and try to make a spread of around 40 to 50 pips between the low and the high. When they are making a narrow range consolidation, we don't enter into the market, and we note down the market timings followed by that of the players. So during the early and the late sessions of each of the sessions, Japanese, European and US sessions, with the help of another slide I will show you that session timings, and during that time they handle the majors, and then it is worthwhile taking positions in the majors during that time frame. If you try to take the positions in the majors during the mid sessions, like now 5 GMT, in the middle of the Japanese session, then it will test your patience. The market may not make either upward move or a downward move, and then there might be a small swings happening here which will be really testing your patience, but actually such swings are used to handle the crosses. So we follow the market or the majors and the commodity pairs during early and late sessions. During the mid sessions, if you are not trading in the majors, then you can just take rest or just watch the market. If you are taking positions in the crosses, then mid sessions will be useful. Then also we note down the initial low and the high, and also the net change. So how much of net change is seen, whether it is in positive in the green color or negative in red color. Why we note down? Because this is the net change from that of the previous day close. So on Friday, when the market got closed by 21:30 GMT, from there the interbank treasury arrive at the market closing price level by taking into consideration the last 30 minutes trades, and then that average level is fixed as the closing price. From there, how much of rise or fall has happened currently by 06 GMT? Euro has gained about 17 pips from that of Friday close level, and USDN has gained about 1 pip. This way you will be able to note down the net change, and these net changes are used in order to determine what is the permissible limit, whether they can drop or rise the market how much. So we cannot just imagine that they can drop or rise the market indefinitely. They have the limitations. The banks have got the limitations around 150 pips. They can drop or rise on a given day. Similarly, 350 pips, they can drop or rise in a given week. So based on those limitations, they try to make the moves in the market, and this is the fourth decimal change. So actually these sort of moves really do not affect the currency conversions which is happening in the banks. Normally when you go to the bank, they will give about 200 to 300 pips below that of the market in case if you wanted to buy, and above that of the market, or if you wanted to sell, then above that of 300 pips or 200 pips above that of the market if you want to buy. So that is how they keep the spread around 500 to 600 pips, and so they are unaffected. We are seeing only the fourth decimal changes and third decimal changes mostly, and if they make 100 pips, then probably 1 cent variation will be seen, 1.27 to 1.28 or 1.26. So this is mainly for the speculative purpose, and you know that they have gone to that level of fifth decimal in the banks, and there they are making the moves, and some of the code pages you might be able to see the fifth decimal as well, and that sort of trades are mainly done. And when they are doing consolidation, primarily they are just floating the market to make the market appear it is live. Otherwise, if it is static, people will not be interested in taking positions. So they have to necessarily float the market, make small pip changes, about 2-3 pips drop and 2-3 pips rise, and this sort of thing. And so the floating the market is being achieved by selling from one terminal and buying from another terminal, and selling from the third terminal and buying from the fourth terminal. That is how they do the circular trades among themselves. As a result, you come across the market appears floating. Now, after understanding that how the market is being structured, because we need to understand that how the majors are suddenly making the upward move or the downward move, and you know that fundamental is used as one of the reason for it. Besides, the technical is also used as a reason, and you know that fundamentally when there is a data release, and immediately the market could make an upward move or a downward move. Similarly, technically, when it reaches the oversold condition or overbought condition, the reversal could happen. So that is how people perceive the market. But actually the players are not having that much of mindset to go into the details of all the studies. But what they do is they simply watch the live market code page and also get the insider information, whether the traders are net long or net short from time to time. Based on that, they try to make the moves in the market. So when they find that the traders have taken pretty long positions, then immediately they make a dip and hit their stops and then go up. And similarly, if they find that the traders have got the short positions, then the players make the market move upward and hit the stops of the traders and then start making the downward move. So ultimately on a daily basis, they enter in and exit out of the market. Besides, they take the positions for a long term, and that we need to understand, because the positions what they accumulate for the long term is more important in driving the market rather than the small swings they do it, and it might appear the market is following the technicals. When it reaches the resistance, it comes down. When it reaches the support, it goes up. Then you will find that, okay, the charts are working very well, the statistical analysis are working very well, so we can follow. And suddenly, when they find that the traders have taken more sell position after the drop, that is, I used to call it as after the visible drop, if the traders continue to take sell position thinking that it will go down, then the players have already accumulated the positions and they gain the levels. Only then the short sellers will try to come and buy at a higher level or place the stops. So whatever the positions they have accumulated by keeping at a lower level, they try to sell it to that of the short sellers. Then again afterwards you find when they hold it at a higher level, the traders try to do the technical trade of buy it after the rise and see that the market is consolidating and they think that it could go up. But the players drop it and induce the long holders to liquidate the long positions like this, what they have done it from last week. And then once the traders liquidate the long positions, losing the patience, the players buy all those sells and try to take the market upwards. So this is how they trade against us. And you know that market players, the market maker trading platforms, so the platforms say visibly that we trade against you, and that is why they are called as a market makers. They only get the market feed from that of the interbank treasury, but they take the risk of trading against that of the traders. How come a big broking company can trade against that of the traders? And so if there are about 1,000 traders, and if all the 1,000 traders in that particular broking firm try to take the positions, and if they all make money, then the broking firm has to close that organization because they have to shell out from their pocket. But how come they are able to successfully run the business? If you question that, we come to that truth that 95% of the traders lose money in the market because of their emotions. So when they emotionally take the positions, or when they get convinced that the market is bullish and try to take a buy, or get convinced that the market is bearish and try to take a sell, they get trapped. So that is the actual fact. Based on that, the market makers are able to trade against us when you open trading account with them. So what we need to understand that they ask us to follow the technicals and fundamentals, but they trade against the traders. So what is the meaning of it? That means they trade against the technicals and fundamentals. But not all the time. Why? Because they get that definite information. The traders are long and traders are short, net long and net short. Then only they make the moves in the market. And so we need to understand that the market makers are one such players in the market. They try to earn when 95% of the traders lose. Okay, then you come across the other type of platform like ACN, etc., and people will think that the trade directly goes to the bank, so we are not worried and definite fill will happen and things like that. But there again you find that somebody is trading against us. When we are willing to sell, somebody is willing to buy there. And then similarly, when we are willing to buy and somebody is there to sell it to us. So we need to understand that in the platform level they call it as a market maker, but in the bank level if they call it as a market maker, and you find that the codes or the trades go to that of the bank, there they try to trade against us. Ultimately, predominant of the traders, or when thousands and thousands of traders do sell and buy trade or a buy and sell trade, you come across ultimately there is a group which is trading against all the traders, because it is a man-made market. So obviously men have to take positions, and somebody has to take positions on the sell side, somebody has to take the position on the buy side. So when predominant of the traders are willing to sell, there is someone who is absorbing all the sells. And definitely, if you question, when they are pumping in huge money and taking all the positions, they are not fools. And they pretend as if they are fools and fool everybody later on by quickly making the opposite move. That is why we come across the market. In the market, the sentiments are created and the market moves against that of the sentiments. So this is what happening day in and day out, and that we need to understand in order to become a successful trader or try to earn money from that of the market. And if we try to learn any other technique, it might work on certain times. When the data release comes, and immediately you will find the market will make the move against that of the expectations of the traders. Then if you ask anybody, they will say that during such market trigger times or data release time, don't take positions and better wait for the market to settle and follow the technicals, then try to take positions. And if you do that, you will be able to earn about 5 to 10 pips, 15 pips. But big moves happen only during that other market trigger time. So you like to participate during such time, but unfortunately you are afraid. Then the second situation comes in, that okay, we know in the market calendar that there are various data release time frames which are being released or which are being advertised beforehand. So you know that okay, around 8:30 GMT there will be a data, or around 12:30 GMT there will be a data release and things like that. But there are unscheduled data release in the market. And if you try to do small swing trades as a scalping, suddenly unscheduled data release can happen and the market can get used that as the trigger and suddenly make a big move. Then when you question why suddenly the market moves, and when you search in the web and also ask so many experts and things like that, you may come across some downgrade story or an upgrade story and things like that, which is being released after about 15-20 minutes. By the time your position is not waiting, which is stopped out. So ultimately we find that market continues to give the surprises. And how exactly we will be able to get rid of such surprises? Because when men are able to trade against us, we need to read their intentions. And if you try to read their intentions carefully and systematically observe how they are trying to act cunning against us, because in the money or the financial market, only by giving cunning statements or statements which are vague and subsequently they modify the statements and things like that and say that what they have done is correct, and that is how the people are in a position to earn money from that of the market. And you know, there will be a lot of promises when you go for investments and things like that, and later on they will say that in a small letters, and market means risk, and in the untoward instances you may not be able to get the money, and also there is no guarantee that the past performance will be reflected in the future. So these are all the statements they give it, and thereby you know that you look into that of the returns and things like that, finally you find that that particular return is not given. And all happen because men trade against other men, and in that process the money powered players, they have the larger investment and they do not want the investment to go astray or get reduced, so they try to act very smart against that of the traders, induce them to commit the position and later on trap them. So this is the story you come across on a daily basis, so that we need to understand. So by market reading technique, we are in a position to find out what the players intend to do, what sort of moves they intend to make, whom they are trying to trap. Are they trying to trap the long holders, or are they trying to trap the short sellers? We are not in a position to find out that. The best thing to protect your equity is using hedging. And in many places, when you say that you want hedging facility to limit the risk, they will say simply that you do not know how to trade. Because if the hedging facility is given, then you will have a buy position as well as a sell position, and your equity is protected. And the players are not in a position to earn money from you. And that is why they just try to say that if you want hedging, that means you do not know how to trade, and you have to use stop and try to read the market and try to trade as per the market sentiments. So the market sentiment might appear bearish, and the market, okay, fine, it's better to do a sell and buy trade, and you take a sell and keep a stop. Then later on you find that market hit the stops, and later on it may make a drop, but you are not having a position. So if you use the stop, they hit it. Then ultimately what the traders do, they avoid keeping stop, because if you keep the stop, only then the players can hit. If you avoid keeping the stop, probably nothing can happen. But the players have got another trick of making very big one-sided moves for 1 or 2 days on the downside or on the upside, and try to see that you do the averaging, and that leads to over trading. And then later on, if they make one more push, you get the margin call. So you have to understand under what circumstances we are trying to trade. It is not that your forecast is perfect, your market understanding is perfect. Ultimately, it reflects on how you are able to perceive the market, how you are able to find what the players intend to do. So if you are able to understand what the players intend to do, then you will be able to use all the preventive techniques, because we don't have the money power to hold the positions when they are making moves against us. And if you use the stop, they hit the stop and make the move in tandem with that of our expectations. So ultimately the trading strategy is going to help. Any type of forecast, whatever be the time frame you use, or whatever be the type of derivations you use, the statistical analysis you use, ultimately the trading strategy is the most important thing in order to be a successful trader. And that is why I give more importance to that of the trading strategy. Now, based on the forecast of the market trading, we decide, okay, now they are showing the net change as the positive net change here. In the case of Euro, USDN and GBP. So that means they are making a contrarian move in the mid-session. So we understand that we don't enter into the market. We enter and exit only during the quick market moves time. So when they make a quick market move, then we try to enter and exit. And when they are closer to low, closer to high, we try to participate in the market. Otherwise, we don't. And also we recognize what currency they will move first. Now, if you see that AUD has made about 36 pips positive net change, and GBP has done 12 pips positive net change, Euro has done about 20 pips positive net change. You can watch without taking position today. They will try to gain more in the case of AUD, and later on they will gain the levels in the case of Euro, and then GBP is expected to gain the levels for the week beginning. So this is how they try to make the moves. And similarly, in the case of USD, CHF and Canadian dollar is making 27 pips negative net change, and CHF is making 11 pips negative net change, and USDN, even though it is a denominator currency, which is showing positive net change because it is making contrarian move now, and later on it might also make a small dip. So Canadian dollar is expected to move first on the downside, and later on the Swiss franc lesser proportion, and finally USDN. This is how they make the moves in the market, and that we need to track. If you watch them in the live market code page simultaneously, all the four majors and two commodity pairs, you will be able to understand they make moves only in the case of majors and the commodity pairs in order to make big moves in the case of the crosses. So that is very important for us to understand. Now, let me go to that of the expected market moves for this week. which is derived based on the forecast. So week beginning false move. Normally they do it during that of the second, third weeks. The week beginning false move. Then later on they are expected to make the intentional move, either on the upside or on the downside. Now today the week beginning false move they are expected to make during that of the late European session. Then followed by swing and gain moves could be seen during US session, even though it is a holiday in US and they are expected to gain the level slowly today. And tomorrow, 13th of November, a dip is expected to happen during Japanese session, followed by either way volatile moves. And you know that about 2-3 months back they used to make either way stop-ins on Wednesdays. But nowadays they changed it and they are trying to do it on Tuesdays. So either way stop-ins could be seen on Tuesday and Wednesday they are expected to make the quick rise from the Japanese session, followed by swing and rise moves during the rest of the sessions. Then Thursday again they are expected to make the slow gain initially, and later on quick gains are expected during European and US sessions. 16th, Friday weekend, they are expected to make swing and volatile moves during Japanese session and try to hit the stops below that of the low, above that of the high, and things like that, and consistently gain the levels during the European and US session. So that you might be able to watch it, but you will find ultimately moderate gains happening, probably to that of the earlier highs. And what they have done it last week, the first and second after the non-farm payroll, they started making the slide and made some swings last week, and then subsequently made for the slide on Friday. And this slide is mainly to bring in the shift in trading zone to the higher levels. And as the weeks proceed, this week they are expected to gain nominally, and next week and the week afterwards, that is 19th to 23rd and 26th to 30th, they are expected to make the aggressive gains in the case of Euro and GBP, and also USD Yen and USD CHF. In all currencies alternative they are expected to gain the levels, and later on you will come across that a shift in trading zone on the higher side is expected to happen by the rest of the 2 weeks, and also during the first week of December. So they are all the expected market moves. So let us see how exactly this is derived by the forecast, and we have to compare it with that of the actual market to understand how far the market follows the algorithmic derived forecast. Now with regard to the initial lows and the highs for the day trading, you find the highs and the lows are not breached in the case of Euro, even though it has formed around 2:30 GMT, still they are not breached. Actually we wait up to 3:30 GMT and make a note of it, but they are not changed, and it looks subdued moves happening in the market, and people might be thinking it is because of the European holiday, the market, US holiday, the market may not make any big moves. But if you carefully watch it, in GBP they breached the high, and 59.11 has become the new high, and 59.07 was the initial high, and they are holding around 59.08. So slowly they wanted to gain the levels in the case of GBP, and Euro will also follow during that time. Then USD Yen 79.41 and 79.56 on the low and the high, they are not breached it. And in the case of CHF 94.69 and 94.88, they are not breached it. And Canadian dollar 99.90 was the low, they breached it and formed 99.88, and the high was not breached. Similarly in the case of Australian dollar, 1.0387 is the low, 1.0422 was the high, they have breached it by 1 pip. So which indicates that they wanted to make the USD weakening move. That is why they had just made the moves in the case of the commodity pairs first. Then later on they will come to that of the majors after handling the crosses. So they intend to make a further drop in the case of USD CAD and gain in the case of Australian dollar, followed by that USD GBP is expected to gain along with that of euro alternatively. In order to handle euro GBP cross, they will alternatively make the gains in the case of GBP and euro. And you know that GBP is the currency which is used as a sentiment creator in the market. So they will try to make the swings in order to create the sentiments against that of the traders. And when the traders commit positions, the players will move the market against their expectations. So that we need to keep it in mind. Then expected market moves for today. Swing and firm up moves are expected during Japanese session. Now we need to note down the session timings after the daylight saving system is off in Europe and US. The session timings are as follows: 0030 to 7:30 GMT is the Japanese session, 7:30 to 8 GMT is the gap time, then 8 to 14 GMT is the European session, 14 to 14:30 GMT is the gap time, then 14:30 to 21:30 is the US session, 21:30 to next day 0030 GMT is the gap time before the start of the Japanese session. So moderate gains could be seen in this particular week, and people might think that the market is not making any interesting moves, so we can do small scalping and things like that, and suddenly from that of Wednesday they are expected to make high level moves, or the moves to take euro and GBP to the higher levels. Frequent contrarian moves could be seen in this particular week in order to handle the crosses. Then the rest of the 2 weeks they will come to the majors and try to make big moves. And if you have got any questions, you can post it in question answer box window or in chat window. I'll try to answer to those questions. So slowly they are making the moves in the case of euro, and GBP they are just taking it at the higher side. So when you look at that of the supports and the resistance, and probably you might find that it works very well. When it comes to that of the resistance, the market could come down. When it goes to that of the support, it might go up. Then you will find that okay, the going is good, we'll try to take small positions, and when the going is further good, you find that in small mini accounts or small mini positions we are able to make good profit. Then you will try to commit more positions in order to earn big when they are making small swings. At that time they make big moves and try to trap you. So that is why you find that what all small profits earned will go in one trade when the market moves against us. So that we need to keep it in mind. So more than that of the emotional control, you try to control taking the positions in the market so that your emotion is not triggered. So when you try to take the positions like 1% or 2% of your equity, you try to take the positions, and when they move the market, there will not be much of an erosion of the equity. Then your fear is not triggered. Then you are able to think calmly and see whether it's a bad trade or a good trade, whether you can take it or simply close the position and later on review the market. That sort of decisions you will be able to take it once you have small positions. But if you try to average when 20-30 pips moves and try to see that okay, by averaging I'll be able to earn, they make big moves like 150 pips moves against you, and all the trades will be making loss and take away the equity, and you will be forced to close the positions, and that leads to reduction in equity. Then the market fear grips in, and with a lesser equity you try to earn back the last money. Then you try to commit again more positions, and they bring in the margin call. That is why many of the traders learn out of a costly experience of closing their account 2-3 times. So don't do that. Best thing is, instead of controlling emotions, and you might find it extremely difficult, you try to take a decision that I will not take more than one position at a given time, irrespective of the market moves, and after closing that position I will try to take further one more positions. If you take a decision of that nature, then the players cannot shake you. Okay, here is a question from Lambert. How do you see the stock market for the year? Okay, the world stock markets are expected to make further gains nominally uh, in this month and also the early part of December, and later on you will come across the profit booking moves on the downside. Again next year, uh, for the year beginning, there will be some lackluster moves and the market could make the corrections. And you know that the players drop the market and buy. You need to understand that. So they drop it and induce the traders to liquidate the delivery-based stocks. And later on, they are expected to take up the market from February onwards. Then kite. Okay, there is another FX, USD yen for today. USD yen is expected to make nominal gain and then make a dip. So you may not come across a good trading opportunity today. When they make a quick move in USD yen and try to take positions, and they may gain about 10 to 15 pips and things like that, and later on come to that of the low during the day. Then Chow kite. How deep is the slice do you expect during the European market for euro? Okay, now the low they have set it in the case of euro and GBP, and they are not breached it. So as I explained, that they are expected to firm up towards close of this Japanese session, and European session they are expected to swing up and then later on slide. So during the slide, they might take out the stops below that of the low and then start making the rise. They may use that excuse that it is a US holiday, so traders are not willing to hold the positions till tomorrow. They may just induce the traders to liquidate, and later on they are expected to make the firming up move. So what I suggest is, if you want to do a long-term trade, then wait for the market to stabilize today and also make some more downward stop on tomorrow and try to take the position as a position trade. Then Wednesday, Thursday, Friday, you will be able to see considerable profit. And if you hold it after keeping stop at entry, you might be able to see further profit during next week and things like that. And try to maximize the profit out of your trade using a trailing stop and also moving away the limit away from that of the market. That way you will be able to maximize the profit. And if you try to patiently hold a profit making position and quickly close a loss making position, you become a professional trader. Okay. Any more questions? Okay. Euro CHF. Now coming to that of the crosses. See, because of the contrarian move in the case of Euro, GBP and USD yen, you find Euro yen has gained about 16 pips and GBP yen has gained about 11 pips. Nominal gains are seen as a positive net change, and you find that most of the crosses are showing positive net change. Now coming to that of Euro CHF, which has come to 1.2061 level, when it was considering, you know that it was consolidating around 1.20 for a prolonged period, and they are expected to take it to the higher levels. And you know, Euro GBP, they had dropped it from that of the high of 0.90 level, and you know, Euro CHF also dropped from 1.30 level to almost to that of the parity, and now they are reversing it. It has come to 1.20, and people say that it is being pegged and things like that. They are expected to slowly take up Euro CHF also to the higher levels. Don't sell. Don't do sell and buy trades here. Whenever there is a quick drop, you try to take buy and keep stop at entry. If it is stopped out, fine. Wait for the next day near the low, you take another buy and keep stop at entry once it start making profit. And you will find that they are expected to make one big upward move. At that time, if you hold the position, you will be able to make sizable profit. Very soon, before the year end, they are expected to take Euro CHF to that level of 1.23 or 1.25 area. That's what my derivation saves. Okay. Now, Lambert, do you see larger movements returning to the market? Yes, definitely. The players make big moves in a market on two occasions. One, when the traders have committed more positions either side, then either the higher level buy and the lower level sells, then the players make big moves in a market to hit the stops either way. The other way of making large moves is if the traders are not committing positions in a market when they are making consolidation of this nature. In order to induce the traders to commit positions, they also make big moves. So the traders might think that, okay, let that definite data come, say probably FOMC minutes come, then later on we'll take position. They'll try to make big moves in the market. Then automatically out of the motions you commit positions, thinking that market is definitely heading upward or downward, you commit positions. Then later on you find that they stop out the stops. So they make the big moves in order to attract the traders to participate in the market. And also they make the big moves during the month beginning and the month end time in order to hit the stops on either side, and also in order to earn more money from that other derivative markets like options and futures. So there the players take the leveraged positions, the traders take leveraged positions, so they have to make, before the expiry they lose the money. So they try to make big moves. So big moves are part of the market. Okay, Sabir. If dip is expected, why can't we short at a higher level? You can do it, but they have already made the drop. Intraday swing trades you can always do when the high is not being breached for more than 30 minutes. You can take a sell near that of the high and quickly book profit near that of the low, but you will be aiming for about 14 pips or 10 pips. If there is a spread variation, then probably you may get about 10 pips. When the spread is so small, between the low and the high, less than 40 pips, there's no point in taking positions. You can earn only about 5 to 10 pips. So what they intend to do is during European session gain some about 40 pips, and you know that they could make an extended rise above that of the high and stop cutting the new high, make the spread about 50 to 60 pips and stop cutting the high for more than 30 minutes. Then you take a sell, and during the drop, when they come closer to low, or just see that you can use a trailing stop and book profit. You can always do that. And only thing is, why I'm just suggesting for small traders, because traders invariably go with that of the emotions. If you are a professional trader, when the position is making loss for about 2 hours, you just close it. You know that they are expected to make the moves against us. But when you become possessive of your position, then you don't take appropriate trading strategy, like keeping stop at entry and things like that. Then comes the biggest problem. When they make a big move on the upside, you get struck vulnerably. I do not want that to happen. That is why I say that you wait for the drop, then you enter long positions. Not otherwise that I am afraid of doing sell and buy or a buy and sell and things like that. So ultimately, the level of understanding of the market will determine the type of trade you can do. Any other questions, please? Okay. No more questions. So it is almost 5:45 GMT. So I'll just explain. Now basically, the forecast is derived based on a statistical algorithm and fine-tuned using the market reading. So the expected market moves, I am posting it on a daily basis, and inoindices.com/blog and also fxtrade.net. You can just go through that and try to use as a reference for your market study. Then you can also do the market reading following my technique, because this is what the players do, so that I got it and I am trying to explain to you. In 4 majors and 2 commodity pairs, they set the initial low on the high around 3:30 GMT. From there they try to make the type of moves, either stop and on the upside or on the downside. Above that of the high, upside stop and below that of the initial low, the downside stop and if it is a stop and they have to return above that of the initial low, or below that of the initial high in less than 30 minutes. Then if it is extended move, up to 2 hours they hold it and reverse. And if it is an intentional move, they just make the continuous move for 2 sessions and then reverse on the 3rd session. So if you could understand this, then you can participate in the market very easily. And we use the trading strategy. During the mid sessions we don't enter. During early and the late sessions, when they make quick moves, either quick upward move or a quick downward move, we take the contrarian positions. When they make quick move on the downside, we know very well they try to hit tops and rise. So at the time of hitting the stops, we buy so that our stop is not hit. Still, we use the hedging order to limit the risk and keep stop at entry once the position makes profit. When they just try to make move above that of the initial high, we watch and find out what sort of move they are doing it, either an extended move for 2 hours or an intentional move. And depending upon that, we exit out of the position. So we need to understand the moves and try to enter and exit. During quick moves, the quick moves are false moves in the market. Then Tepu has got a question, whether euro is expected to rise to 1.42. That is what expected theoretically based on my forecast algorithm, but we have to wait and see. And I'll fine tune it using the market reading, but that is the gross estimate. The euro and GBP are expected to go to the higher levels by year end. So these are all the initial lows and the highs. In GBP they breached, and also in the case of Canadian dollar they breached the initial low, and Australian dollar they breached the initial high, indicating that they wanted to make the USD weakening move till the early European or mid-European session, and later on they intend to make the slide. During that slide, you can try to buy and wait for the small swing and firm up move, and then try to close it tomorrow when they firm up. And then again tomorrow they are expected to make the either way stop ends. So exit when they are making a quick upward move, and then again re-enter when they are trying to make a quick downward move. That way you can do buy and sell trades. Otherwise either way trades also, buy and sell and buy, provided you are able to control your emotions. Otherwise you might get trapped if you don't use the stop or keep stop at entry. So I take this opportunity to thank FX Trade for the facilities given to present the webinar, and also thank you for your interest in attending my webinars and learning my trading system. And we'll meet again on Thursday, November 15th, and review what all the expected market moves I have given it for this particular week, and also analyze for Thursday and Friday what could be the type of moves we could come across in the market. And these are all the informations we just gather in order to fine-tune our trading strategies. It is not that my forecast is good or your forecast is good and things like that. Ultimately, are we in a position to earn money from that market? That is more important. Focus on rather than entering into any sort of dispute and creating emotional clash and things like that. That may distract you from trading. So, thank you one and all. See you on Thursday.